Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, January 30th, and then we'll see how things look for Wednesday, January 31st. We had a slight down day. It was pretty much unchanged. It was a pretty slow day when you take everything together. We're still positive, but we're still looking overextended to the upside. In Wednesday's session, it's all about the Fed, and specifically all about Jerome Powell and what is he going to say at his press conference. The market will be sitting there watching every syllable, trying to read some secret meaning into everything, and then reacting either positively or negatively. But let's go back and talk about what happened on Tuesday. Right at the open, we had a lower open and prices drifted lower, and then we were able to bounce back up a little bit, but we hit resistance at the unchanged level. Just like before, the unchanged level was acting as support on an up day. Well, on a down day, it tends to act as resistance. As the day went on, prices fell, but we didn't get all the way down to the daily pivot at 49.15. So we saw a little bit of selling, but it wasn't all that strong. And then we drifted back higher and we closed slightly negative on the day. We were down 0.06% on below average volume. And we are positive with our technicals. It's all about the Fed in Wednesday's session. And we'll have to see just how the market ends up reacting to that. We're hoping that things will become a little bit clearer since we've been getting some mixed signals with our economic reports, and the market doesn't really like that all that much. But at the same time, there's always uncertainty in the market that we have to be aware of. Some comments that we can make: the Dow did set another new all-time high. With the down day, the S&P didn't, and the NASDAQ 100 was also down. We're still above 4,900 with the S&P 500. The mega caps and semiconductors, they underperformed. And incidentally, in the initial overnight session, Microsoft and Alphabet, which is Google, they made their earnings reports announcements, and they're getting hit pretty hard. But it's the old buy the rumor, sell the news kind of thing. We'll see if that carries over into the cash session on Wednesday. On a short-term basis, we have the Stoch RSI, the Williams percent R, the CCI 14 and 20, the stochastics, the standard deviations chart, and the boom indicator, as well as the RSI based on 9 periods. And that is pretty much the same list that we've been seeing. And these are our usual suspects here, because whenever we move in any particular direction, these are pretty touchy indicators, and they can give us pretty extreme conditions without really seeming to do all that much. Intermediate term, this is a little bit more of a concern. This is a long list, and it's been a long list now for a while. With the CMB composite, our oscillators in the short and intermediate term, they're starting to look more extreme again. The Sean trend meter, the RSI based on 14 periods, the bullish percent index, both for the S&P and the NASDAQ 100, the boom indicator, and then the new high, new low study for the S&P. Same list that I pretty much have been showing for the last week or so. There might be some things that are added and then drop off, but this is pretty much the same list. Also the same list of what we're seeing in the long term. We're above and looking extreme with our 150 and 200 period simple moving average studies. And then this is the scenario, and as I've been stating before, is there going to be a modification to this scenario that the Fed might in fact be done raising rates and possibly even entertain the idea of cutting rates? Now, the employment situation is still looking pretty strong, and that's what the Fed has been using to justify raising rates anyway. But the market is still kind of holding out hope, and there has been some talk of cutting rates probably further into 2024. We want to keep an eye on the economic reports in case they are stronger than expected and the Fed doesn't have to come back in and actually raise rates. The dollar was up and interest rates were down. We fell a little bit with the 10-year yield. We settled at 4.06%, but that's still above the 4.02% that RenMac suggests that when we get above that level, that's when it can start to eat into corporate profits. The 10 to the 2 and the 10 to the 3 month are still inverted with their yield curves. We did tick down with sentiment. We're below that 75 level. We had got up to 77, and now we're starting to come back down a little bit. We're still positive. But when we get above 75, that's when we start to look at, okay, maybe we need to look at this in a contrarian manner. Is this going to be the beginning of something, or was this just a normal pullback before the market gets set to go higher? Our trend is still positive with the green line on top, both in the short and intermediate term. They're strengthening trends. Both are above 20 and both are above their moving averages. I'm keeping our bias at positive right now because it was virtually an unchanged day, and I'm definitely keeping our momentum at positive since the last number of days have been positive. The economic reports that came out, we had the FHFA Housing Price Index. It came in the same as last time, being up 0.3%. The Case-Shiller Home Price Index was up 5.4%, less than the 5.6% that they had expected, and up from the 4.9% we saw last time. Consumer confidence, this is showing some improvement here. It came in at 114.8, greater than the 113 they had expected, and last time it was at 108. The JOLT job openings actually went back up to 9.026 million, where it had been last time at 8.925 million. Here are some charts. First, looking at the FHFA Housing Price Index, where this is just showing a pretty steady climb right here as far as housing prices are concerned. Now, when we look at the Case-Shiller chart later, it's not as upward of a move here. And this is actually showing a little bit of a decline where we're coming down just a little bit. So we're seeing a little bit of contradiction with the housing price information. Here's consumer confidence. The blue line is the reading that we received, and that is showing some improvement. The purple line is how do people feel right now, and that's also improving. And then the yellow line, how are people looking out into the future? That's also showing some improvement. The job openings, after they had been declining and coming in under 9 million, they're starting to go back up a little bit over 9 million now. And here's an interesting chart, and I want to kind of warn you about this chart. Since I've been an educator for a long time, I, believe it or not, have taught math from time to time. And you can take numbers and manipulate them any way you want them to read. Excuse me. And usually we look at the core PCE inflation on a year-over-year basis, and that's the blue line that we're seeing here right now. Well, if you drop it back to a 6-month annual basis, or however they figure that one out, it actually has us down below 2% right now, and that's what the Fed is trying to get to. Just, it's interesting to know this, but at the same time, realize that numbers can be manipulated to say pretty much whatever you want them to say. Here's our intraday chart where we did have a lower open. We tried to break out and go a little bit positive. We drifted lower, tried to go up again. We were hitting a lot of resistance here at the unchanged level. We dropped back down, but didn't get down to the daily pivot. We came back up to the unchanged level again, and then ended up closing slightly lower. A real sleepy day overall. We were not real changed in the initial overnight session. We did see some weakness. There were some problems and issues going on in Europe, but then we did see a little bit of an improvement during the cash session here, and we closed down just a little bit. This move down, this was when Google or Alphabet and Microsoft reported their earnings, and they make up part of the S&P 500. So that's why this did decline, but it has been bouncing back a little bit since that time. Looking at growth versus value, where value is now on top. The red line is above the blue line. This is a little bit discouraging. It's a little bit of a warning sign. We want to see the blue line on top. That's when the market really tends to kick into higher gear. And we did close down when we look at our growth to value ratio for the SPY, where growth did underperform. Our end of day charts show that growth was down where value was up, which is interesting. As I was watching the day, growth spent most of the day being up more than value. It was later in the day that we saw growth show some more weakness. It was down, but down less when we look at mid-cap growth versus value, and it was also down less when we look at small-cap growth versus small-cap value. Here's our end-of-day chart where we actually went up a little bit with the growth-to-value ratio for the S&P. It's kind of interesting. We ticked down when growth outperformed in Tuesday's session, but then we underperformed, no, excuse me, in Monday's session, we underperformed in Tuesday's session, and this actually went up. That's why I use a lot of different indicators, and I use different things to measure these charts because they're all calculated in slightly different ways. Keeping an eye on discretionary, we're showing a little bit of an improvement here with our equal weight ETF for discretionary. Staples, we're also up slightly, so we declined just a little bit with our ratio between discretionary and staples. We want to see this going up the way the S&P 500 has been going up. That's still a negative divergence that is causing us some concern. Here is growth versus value that I got from Isabel Net. This just shows how growth has been outperforming, or you could say that another way, that value has been underperforming. Here's our trend. We're above the moving average. The green line is on top, even though it did decline slightly, but this is still positive. In the short term, we're also showing a strengthening trend above the moving average with the green line on top. Volumes, we're kind of coming back down to about the average level. Here is sentiment. We're still just not seeing much fear when it comes to the Ulcer Index. We ticked down a little bit with the VIX and the line chart as well as the bar chart. We also are showing a bit of a decrease in the VIX of the VIX, which is kind of strange on a down day, and we spent most of the day being negative. You would have thought this would go up, but no, it actually ended up declining. The equity put call ratio did go up a little bit. Again, this could be some hedging that's taking place, but what's a little concerning now is our 5-period is continuing to go up. When I did the video for Tuesday's session, I thought, this is just an anomaly. Now that we're seeing this a couple days in a row, we have to kind of put this over on the warning side now. And we're also keeping an eye on the SKU index. It's coming up into the red area. It's starting to drop, but it isn't quite out of this red area yet. This is just anticipating a big move, either up or down. That's what the market is thinking will happen. We don't necessarily know the direction, but given that the Fed is going to be coming out and speaking in Wednesday's session, it's not really a surprise to see this. Our advanced decline line studies, we are still showing some improvement based on price. We're actually breaking out above this previous high, and we're showing some improvement here, even though we were flat based on volume. Looking at the new highs minus the new lows, we're turning up just a little bit with our 5-period, even though we are pretty much pegged near the top. But you can just look at the green is really outnumbering the red, and we are starting to turn back up with the 10-day moving average. So this is still showing some internal strength. We're above zero and advancing with our advanced decline ratio. That's positive. This is also encouraging. Accumulation distribution still has us above an advancing moving average. The Chaikin money flow, the red moving average is starting to turn back up. That's also positive. And the Chaikin oscillator continues to go back up. So the smart money still seems to be doing some buying. Here's our NYSE advanced decline line where it ticked down just a little bit, where we were down slightly with the S&P. And looking at our advanced decline line studies, where we ticked down with the common stock on the NYSE, we actually advanced a little bit with the S&P. We declined with the mid caps as well as the small caps. Here's our daily chart, where we're still looking okay here when we look at the bars all together. We haven't dropped below any of these pivot levels, support levels, at least yet. And then on the bottom, I guess we were above average with volume here. I thought that I saw where it was below average. But when we look at our short-term indicators, we have the Stochk RSI is extreme positive, as is the Williams percent R, the CCI 14, and the CCI 20. We ticked down a little bit with our 20-period moving average study, as well as our 50-period. We're still advancing with the 200-period. And we're still looking okay with the force index. We did decline, but we're above an advancing midpoint. We're still extreme with the stochastics in the short, intermediate, and long term. We're still in the +3 channel with our standard deviations chart. Intermediate term, we turned down. This is 2 days in a row. We've seen the balance of power actually go down, but we're still above the midpoint. So it's positive, but showing a little bit of weakness. We're positive with the go, no-go system with the darker blue bars. We're still hugging the highest high value with our highest high, lowest low value chart. The TTM squeeze continues to show some improvement with the lighter shade of blue. We're still extreme positive with the CMB composite. We're continuing to go down a little bit with the ease of movement. We saw that after Monday. Now we're seeing that after Tuesday. It could be the way this indicator is calculated, but we want to keep an eye on that and just say maybe this is giving us some kind of a warning sign here. But we're continuing to advance with the Arun. We're above zero, so it's positive, and the green line's on top as the red line is declining. And we tick down just a little bit with the S&P McClellan oscillator, but we're still above zero. So that's turning price back up. And we were seeing volume already start to turn back up, which sometimes can be a leading indicator. The McClellan oscillator for the NYSE did tick down, but is still above zero. So we're starting to turn up a little bit more based on price as well as volume. The Swenlin trading oscillator is pretty much flat right now based on price, where we decline just a little bit based on volume, but we're still positive since both are above zero. We're still showing that momentum is getting pretty extreme and it's positive. We're still trying to turn up based on price. We're crossing above the moving average based on volume, and that could be positive. Last week in the videos, I was pointing out how volume was lagging behind price. Now, when we look at some of our oscillators, it looks like volume could be leading price. Then, looking at our PMO studies, we tick down just a little bit with the PMOs that are rising. We're still going up with the buy signals. We're still extreme positive with the PMOs that are above zero. We've switched over to neutral for the Elder's Impulse system for the S&P, but we're still positive with the parabolic SAR. Our slope oscillator starting to get extreme, but is positive. The MACD is also is not necessarily extreme, but it is positive. So in the short term, we're getting extreme with the slope and the TSI. We're looking more positive with the MACD, the PMO, and the PPO. We're starting to turn back up and look more positive with the TRIX and KST, which are our long-term oscillators. We're above all the plotted moving averages in our moving average tree, and we're seeing the red line start to go above the blue line. That's the exponential moving average, which tends to move quicker, which suggests price has more strength. We're still dancing right around, a little bit above, a little bit below the 70 level with the bullish percent index with the S&P 500. We came back up just slightly with the NYSE bullish percent index. We turned back up with the NASDAQ 100 bullish percent index, and we are extreme positive. We're still underneath this 80 level with the money flow index. We weren't able to get up into an extreme reading, at least yet. We actually started to turn down a little bit with the ultimate oscillator, but we're still above 50, so it is positive. The vortex is flattening out, but the green line is still on top, which is positive. We're still extreme with the RSI 14 as well as the RSI 9. Unbalanced volume is still above an advancing moving average. We ticked down a little bit with our 200 period moving average study, and we're chopping a little bit now, but still declining slightly with our 50 period moving average study of those stocks that make up the S&P 500. But the Copic curve shows that momentum is still positive. The Sean trend meter is getting back to being more extreme positive. And we're still extreme with the boom indicator. We're getting kind of far away from the 20 and 50 period moving averages, where we're still looking okay and our distance away from the 200 period moving average. The Heiken Ashi charts, this is still looking positive with open candles. The Kegi chart continues to be positive. The Renko, it redrew a little red box in here, but it's still looking positive. And the 3-line break is also positive. Longer term, we're still looking extreme with our 150 and 200 period moving average studies. Here is the equal weight, which it held up a little bit better since the mega caps and the semis were a bit under pressure. So we're seeing the red line and the S&P weighted index pretty much equal, at least looking at this chart. We did decline just a little bit with our ratio here. That means that the mega caps underperformed slightly. And then I have a new chart after this. This is a longer term negative divergence that we're seeing where the Dow is setting all-time highs. We have not been able to come back to this most recent high with the transports or this previous high here, and that's causing a concern. So what I wanted to do is I brought up a longer term chart of just the transports to show you what I'm talking about. Over on the right hand side, this is where we're at right now. This is the previous high set in 2023 that we've not been able to get beyond. This is the other high that you still see in that other chart, and then we have the all-time high, which was set late in 2021. And this is a closing value chart because that line went to the moon before it ended up closing here. But this is what I'm talking about longer term. And that's why we're seeing different levels of negative divergence with the transports when we compare it to a chart of the Dow. And that's also showing why the transports continue to underperform the Dow. Then I haven't shown this in a while just because it continues to break down. This is a ratio between the transports and the S&P. When this is going down, that means the transports are underperforming. And this is really starting to show some significant weakness. So this is another warning sign to be aware of. But the Dow did go back and set another new all-time high. And we're still positive with the Elder's Impulse system with the diamonds. We're still hanging out okay with the NASDAQ, but we haven't been able to break above these previous highs set recently. And here's our one Fibonacci chart. It still shows that we're chopping sideways and we have a ways to go to get back to the all-time high for the NASDAQ. The NASDAQ 100 is also chopping more or less sideways right now. And we've switched over to neutral with the QQQs when looking at the Elder's Impulse system. We're rolling over just a little bit with the PPO, so the NASDAQ 100 momentum is slowing down a bit here as we've been going sideways, but we are still positive. And the small caps, just kind of breaking out just a little bit, but have not been able to get above this previous high, just set a few days ago. But we continue to be positive with the Elder's Impulse system when looking at the small caps. This is encouraging. We're still above this, what had been resistance level. Now that we've been 2 days above this, could that be long enough to act as support if small caps come under some weakness? We did turn down, but we're still positive with the RSI, and we're starting to turn more negative on a momentum basis with the MACD, and then longer term, we are in an uptrend. The mid caps continue to chop more or less sideways. They are still positive with the mid caps when looking at the Elder's Impulse system. We didn't set a new high with the FANG index. It was under a bit of pressure in Tuesday's session. Financial sector was up 1.25% and is still showing lots of improvement there. The dollar is starting to go back up a little bit here and is rebounding, even though we're working off of a longer term downtrend. We were down with the 10-year based on yield. We were up with the 10-year based on price. And then looking at our growth to value, the Qs to S&P ratio, it is showing some weakness, and we're coming back down to the moving average. That's a little bit of a concern. We're bouncing up just a little bit when we look at discretionary to the S&P, and most of this has to do with Tesla. We want to see this really start to rebound up, and it's improving, but not turning positive at least yet. We tick down just a little bit when we compare large cap growth with large cap value. And when we look at the large caps, we're still above the moving average. We improved slightly with the mid caps as well as the small caps. We're still extreme positive with our 10-day average of the S&P 500 highs minus the lows. We're still positive when we take a 5-period moving average across the broad market. The longer we can stay above zero, the more positive that will be. We are coming down with the 2-year yield, which could end up giving support to the S&P. So what's our outlook for Wednesday? We are dealing with earnings season. Throughout this week, about 20% of the S&P 500 companies, so that'd be about 100 companies, will end up reporting with earnings. We're still wondering, we've got 1 day left now in January, and we're 0 for 2, but that doesn't mean that all hope is lost, and I'll show you here in just a second. This is what I went through yesterday. This is some research that I ran across. It says when 2 of the 3 indicators are negative, and then the third is positive, we tend to have an average of a 20% up return when that occurs. When all 3 are negative, we end up averaging a 3.6% loss for the whole year. Then I added this right here for today where it says we're up 3.3% so far for the month of January, and we have 1 trading day left. So as long as we don't fall more than 3.3% in Wednesday's session, we will have a 1 to -2 score, which on average does bode well for the rest of the year. Our technicals are positive, but we're still looking at quite an overbought condition. We're going to get the MBA Mortgage Applications Index, the ADP Employment Change, the Employment Cost Index, the Chicago PMI. And then the Fed is going to come out with their announcement at 2 p.m. Eastern. And then we're watching the geopolitical events that just don't seem to be having much of an impact right now. In Thursday's session, we're going to get ISM manufacturing, and then on Friday is going to be the big employment report. Seasonally, on January 31st, we're neutral to negative with the Dow and S&P. We're neutral to positive when we look at the NASDAQ. And then this is just suggesting that when we have a positive January, things do look good going forward from here based on this Carson chart. And then stocks don't like a lame duck president, and we supposedly don't have that in 2024, where this tends to be how the market reacts during the fourth year of the president's first term. We will be on the 21st trading day of the month, which is the last trading day of the month, where we do see some positive seasonality. This is also what we've been watching. This goes out for the whole year, showing how we're really choppy. We might see some weakness towards the latter part of February, going into about the middle part of March. And here's the Stock Traders Almanac statistics, also seeing a little bit of weakness before we see some strength. This is when the sitting president is running for re-election. And then I tried to update this here with the purple line. We're starting to match a little more closely what historically has happened. Wednesday tends to be the most negative day of the week. And looking out into February, this is just line charts of all the different indexes where we tend to start off fairly well. We go sideways. We see any strength about the middle part of the month before we see some weakness going into the latter part. That doesn't mean that's what's going to happen. This is statistically and seasonally what has happened. Then here is the chart with some more annotations on it that I'll start adding to once we get into February. And then I said it wrong yesterday, not 40%, not 34%. There's 74 years that they're counting here, and we were up 40 of those years. We were down 34 of those years, so that means that we were up 54.8% of the time. And then this is from Dan Bird, showing how we might see some weakness in the latter part of February, and then we bottom out in about the middle part of March. Again, that might be how things play out. We just use this for a guide, and then we see some strength going on here until we deal more with the latter part of the year. So what are our scenarios? We can't really go with the down one, even though we are overbought. We're going with the up one for right now because our technicals are still positive, even though we are overbought. We're not going with the sideways trend because both ADX charts suggest we are in a strengthening trending environment. The risk on posture is just still chopping all over the place. The transports that I talked about, they continue to negatively diverge from the Dow. And the 5-period equity put call ratio, I had to add it back here to the negative slide. It's been going up now for the last few days. We just want to keep an eye on that. Positive, we're still seeing growth hanging in there for right now. Now, another day of this, and we see value outperforming growth, and we might have to take this off of the list. Our oscillators are positive, but some are already getting extreme positive. The parabolic SAR and vortex charts are positive. The bullish percent index is just a little bit below 70 with the S&P, where it's above 70 with the NASDAQ 100. So I'm counting them both as extreme for right now. The Copic curve is positive, and our momentum, even though it's weakening a little bit for the NASDAQ 100, it still continues to be positive. Small and mid-cap growth is just more or less chopping sideways. The financial sector is still showing some improvement. So our conclusion, we're positive, but we're overbought. In the short term, that's what we say. In the intermediate term, that's what we say. Long term, we are positive and also have some overbought conditions that have been around for quite some time. Thank you. I really hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.